Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Jacobs Solutions, ticker symbol J.
And this is a fascinating one. It's a company that has, completely reinvented itself.
It really has. For decades, if you heard Jacobs, you thought of heavy, traditional engineering. It was Jacobs Engineering.
Right. Founded by Dr. Jacobs. They designed one of the first commercial penicillin facilities, which is just amazing to think about.
It is a huge firm, really rooted in things like the chemical process industry and, big government and hydrocarbon contracts. But that whole identity,
It's basically gone.
that's the thing. The heavy assets, the lower margin work,
Yeah,
that's not the company we're looking at today.
exactly. The name change to Jacobs Solutions, which was, around 2019? That wasn't just some marketing exercise. It was a signal of this fundamental multi-year pivot,
A pivot away from being just a cyclical engineering contractor.
right, to becoming a specialized, high-margin technical services and consulting firm. They just systematically started shedding those lower growth, lower margin assets.
And that all culminated recently with the separation of the CMS and C&I businesses into Amentum,
Yes, and we should probably pause on how they did that. It
Right.
was a reverse Morris trust.
that's a pretty complex mechanism. For anyone who hasn't dealt with that structure, it's really key to understanding how they cleaned up the company.
Absolutely. A reverse Morris trust is it's a maneuver that essentially lets a company spin off a huge division, in this case, CMS and CNI, and do it tax-free for shareholders.
But the key is that the original company, Jacobs, gets to keep the bulk of the value in the assets it wants.
Exactly. It lets them focus all their resources purely on the areas they believe have the highest future growth. It's just an incredibly effective way to realize value and simplify the entire business.
And the success of this strategy, this is the real aha moment for me. If you just look back at the last 9 years of this massive transformation, Jacobs divested roughly 80% of its historical revenues.
80%.
It sounds like a catastrophic failure of scale, right?
You'd think so. An absolute disaster on paper.
Instead, they doubled their Adjusted EBITDA. They doubled their Adjusted EBITDA margin. And because of that radical focus on margin and specialization, their market cap is up 2.5 times since 2016.
It's a textbook study, getting dramatically smaller to become exponentially stronger.
It's the definition of quality over quantity when it comes to revenue, which brings us directly to the thesis we're exploring today. Let's state it clearly.
Okay.
Jacobs Solutions is betting its successful corporate transformation into a specialized, high-margin digital leader.
And that's highlighted by that record $23.1 billion backlog and the huge strategic shift toward AI data centers.
They're betting all of that will fuel 16% adjusted EPS growth into fiscal year 26.
While also, and this is critical, aggressively returning capital to shareholders.
This all has to justify its high valuation, and that's despite these really inherent risks.
The big one being the fixed price contracts, 32% of revenue.
And just the volatility of these incredibly complex generational infrastructure projects. This deep dive will explore how the firm plans to flawlessly execute this aggressive growth narrative while managing all that high-stakes execution required in these markets.
So to really understand the modern Jacobs, you have to look at the very simplified structure they have now, post-separation. It's not a sprawling conglomerate anymore.
Yeah.
We're talking about a lean operation. It's focused on just two primary revenue engines, and both are geared toward those higher margin services.
Okay, so what are they?
The first, and it's the much larger one, is their core engineering and design arm, infrastructure and advanced facilities, INAF for short.
Yeah, INAF, got it.
This is the company's giant operational engine. It's projected to bring in something like $10.76 billion in revenue for fiscal 25. All the large-scale project management, design, execution, it lives here.
Okay, that's the muscle. What's the second piece?
The second piece is maybe the key to their premium margins. It's PA Consulting,
Right. They have a majority stake, not the whole thing.
a 65% majority stake. And PA Consulting is a very high-end innovation and transformation consulting firm. They brought in about $1.27 billion in implied revenue.
So you have this dual structure. You have the high-end strategic consulting from PA, and it's coupled with the deep technical execution muscle from INAF.
That is the key distinction.
Sure.
That's what lets Jacobs get involved in a project from the absolute earliest, most profitable strategic planning phases, all the way through to implementation. They're not just construction managers.
They're strategic problem solvers who can also design and manage the construction.
Exactly. So let's drill into that massive INAS segment because its composition really defines the company's market exposure and, its future bets.
Okay, let's do it. So INAF breaks its revenue down into three main buckets, and it shows a really clear shift towards these essential non-cyclical services. The largest is critical infrastructure, or CI. That's 51% of INAF's adjusted net revenue.
So over half the business right there.
Over half. And this is their strongest, most stable segment. We saw proof of that with a healthy 9.2% growth in the fourth quarter. It's driven by massive public spending on things you can't delay.
Like transportation projects.
Exactly. Big rail expansions, upgrading old energy and power systems, and we are definitely going to come back to how critical that energy skill set is in a minute.
Okay, so what's bucket number 2?
That covers 30% of INAF's revenue, water and environmental, W&E.
Water seems like a pretty resilient business.
It is. Globally resilient. You've got pressing issues like water scarcity, aging pipes in, mature economies, the need for complex treatment. Jacobs is a leader here. They design facilities that can take recycled water, treat it, and make it drinkable for big cities.
But the E part, the environmental side, sounds like it could be more volatile.
It is, and it shows. In the fourth quarter, that segment actually saw a slight decline of 1.1%. And the reason why is really important for understanding their market.
Okay.
It's U.S. regulatory uncertainty. When the rules around things like industrial pollution or remediation or just getting permits become unstable, what do big clients do?
They pause. They wait and see.
They hit the pause button on major spending, so that softness is a key operational risk, even in an area that seems essential.
Right. Okay, that makes sense. So that leaves the third bucket.
Which is the one with the highest growth potential. It rounds out the segments at 18% of INAF revenue, life sciences and advanced manufacturing, LS&AM.
This sounds like where the innovation is.
This is where it's happening. It posted 5.3% Q4 growth. This segment is all about designing and managing these complex, high-tech facilities, and it has two massive growth drivers inside it.
Okay.
The first is life sciences. So supporting the manufacturers of those high-growth GLP-1 drugs for obesity and diabetes.
Right, helping them scale up.
Helping them scale from small batch testing to massive commercial production. And the other, the one that's really driving the current valuation premium, is the explosion in the data center business. That's also housed here.
So those are the two big bets for future margin expansion.
Exactly. Management is betting everything on those two areas.
Okay, before we get any deeper into the growth drivers, we absolutely have to talk about the contract risk profile.
Yes.
Because this is the single largest structural factor that could just derail the whole investment thesis if execution stumbles.
So let's break down the contracts.
The good news first. The majority, 68% of their total revenue, comes from cost-reimbursable contracts.
Which are pretty low risk, relatively speaking.
Very low risk. The client agrees to pay Jacobs for labor, materials, all the associated costs, plus a defined margin. So most of the risk of cost increases gets shifted to the client.
Okay, but the structural risk, the part that you really need to be thinking about, is the remaining 32% of total revenue.
Which falls under fixed-price contracts.
And that's a material exposure. When Jacobs bids on a multi-billion-dollar, multi-year, complex infrastructure project, and they commit to a fixed price.
They eat all the risk. If something goes wrong, it's on them.
And on projects this big, an airport terminal, a massive utility system, there are just so many points of failure.
So many.
We're talking initial design errors, unexpected trouble getting permits, severe weather, or the big ones right now. Massive, unpredictable swings in commodity prices and labor costs.
Exactly. If the price of copper spikes halfway through a 3-year contract, or if the specialized labor you need for an advanced facility demands way higher wages than you projected.
Jacobs eats those overruns.
And that directly erodes their profit margins. Which is why that 32% figure needs constant monitoring, especially when they're also targeting aggressive margin expansion.
So the only way they can manage that risk is through just flawless execution.
Superior execution enabled by technology.
That is the perfect transition, because that staggering level of risk brings us straight to their digital strategy. If you can't control costs with brute force and paper contracts, you have to use technology.
And that's why the partnership with Palantir and their Foundry and AIP platforms is so foundational to the bull case.
So Jacobs is taking decades of its deep domain expertise, all that institutional knowledge of how piping works, how regulations impact construction, and they're fusing it with Palantir's AI.
Right. And this isn't just a marketing gimmick. It's a real structural attempt to fundamentally change the economics of the execution business.
And the flagship example is what they call the Aqua DNA platform.
Right. So this application is built on Palantir's tech, and it's designed to be an AI co-pilot for water utility operators.
A co-pilot. I like that.
It ingests and centralizes all this real-time data from thousands of sensors across a city's water network. It lets operators optimize decisions in real time, especially during, high-stakes events like a massive storm or a critical equipment failure.
But the really disruptive part is in the long-term planning.
Right? That's where it gets really interesting. Historically, if a city had a complex 30-year infrastructure decision, say, is it more cost-effective to replace 50 miles of old pipe or build 2 huge new storage tanks? That analysis could take an engineering team months or even years of manual modeling.
That's just astounding to me. You're saying a 30-year, billion-dollar infrastructure model that used to take a team months to build can now be generated almost instantly by this AI co-pilot.
That's the claim. It radically changes the consulting model. It just crushes the cost and churn of traditional engineering analysis.
It's like bringing aerospace-level data integration, what you'd see in a modern fighter jet, to civilian infrastructure.
Precisely. The Aqua DNA platform enables these complex 30-year simulations almost instantly. It can model population growth, climate change, urban development all across multiple financial scenarios. And that speed gives Jacobs a massive competitive advantage in winning that upfront strategic work.
Which is high-margin revenue.
The highest.
And what's really fascinating and what makes the tech sticky is the governance layer.
Yes. The platform enforces what they call a human-in-the-loop model. The system decides ahead of time which actions are so critical they require human approval. And here's the kicker. It captures a full history of every action taken, AI or human, along with the reasoning and the alternatives that were presented.
That transparency has to be essential when you're dealing with public utilities, commissions, and regulators.
It is. It lets the utility and Jacobs go to regulators and show exactly why a decision was made in a crisis based on hard data, not guesswork after the fact.
And this is translated to actual business.
It has. This combination of domain expertise and data governance led directly to an extended operational intelligence agreement with United Utilities in the UK all the way through 2030.
So that confirms this digital layer is already generating long-term defensible recurring revenue.
Correct.
Okay, so moving from that long-term digital moat to the immediate growth drivers.
Yeah.
We have to talk about the explosion in AI data centers. This is the big one.
It is.
Management is exceptionally bullish here. I mean, they've been in the data center space since 2007, so they have deep competence. But the demand for AI-specific facilities is it's unprecedented.
And the pipeline reflects that.
Their AI data center pipeline has recently increased fivefold, 5x.
Let's put that in context.
We should. The current business is estimated to be around $200 million. So a 5x increase in the pipeline anticipates billions in future revenue from what is still a relatively small base.
And the complexity of these projects is the key to their pricing power, to their moat. These are not just standard warehouses with AC.
No, they're massive gigafacilities. They demand enormous, constant, reliable power. The CEO made a staggering point, noting that the entire U.S. electrical grid needs to expand by 3 times before 2028 just to handle the growth from this sector.
3 times.
3 times. And since the traditional grid often just can't handle that kind of specialized load, Jacobs is moving into what's known as behind-the-meter power solutions.
Which means they are essentially designing small on-site power plants right next to the data center.
Exactly. We are talking about designing the integration of really complex alternative energy sources, things like modular nuclear power, on-premise LNG generation. This is exponentially more complex than just running a line to a utility pole.
And that specialized expertise, that's what locks Jacobs into these high-value, high-margin design and program management contracts.
That ability to integrate complex energy solutions is the moat. If you're a hyperscaler and you need a new AI factory online in 18 months, you need a firm that can handle utility regulations, nuclear permitting, gas logistics, and facility design all at once.
They become the essential systems integrator for next-gen power,
which makes them indispensable at the highest margin layer. And the final piece of this puzzle they locked down is the partnership with NVIDIA.
The Omniverse blueprint.
Yes, Jacobs is the design integrator for the Omniverse blueprint for AI factory digital twins. We should probably break down what a digital twin is here.
Think of it as a perfect, physically accurate virtual replica of the massive AI factory before a single shovel hits the ground.
So you can test it virtually.
Completely. Using Omniverse, the engineering teams can design, simulate, and optimize billions of components in this virtual environment. Airflow for cooling, thermal loads, computational throughput, everything. It prevents costly errors later by ensuring the facility is efficient and resilient from the very beginning of the design phase.
It's risk mitigation at the highest possible level.
You're virtually test running the facility before you pour a single yard of concrete.
Okay, so beyond the AI boom, they are still winning major contracts in their traditional markets, right? Which confirms the strength of that critical infrastructure segment.
They are. In transportation, for example, they have key wins, like the MTA Interborough Express light rail project in New York.
Designing rail expansions, upgrades.
Right. But their scope is global. They're managing huge infrastructure for Toronto Pearson Airport and doing project management for massive international events like the World Expo in Riyadh and even initial planning for the FIFA World Cup in 2034.
And sticking with airports, they were also selected to lead the $1.6 billion modernization of Cleveland Hopkins International Airport.
And when we talk about the complexity of these fixed-price projects, just think about that one.
It's a perfect example. You're managing dozens of subcontractors, navigating federal permits, redesigning the entire terminal entrance, building a new ground transportation center.
And you have to do it all while tens of thousands of travelers are still passing through the airport every single day.
That operational difficulty is what justifies the high contract value.
And we noted earlier that the water and environmental segment had some softness.
Right, the regulatory volatility.
But the long-term government stability is still there. Despite that short-term volatility, they secured a crucial, multi-year, $1.5 billion AFCEC Environmental Services contract.
So that provides long-term, stable revenue from a core government client.
Exactly. It proves the underlying demand is still very robust.
And what about life sciences?
That segment continues to show how adaptable they are. They leverage the expertise they gained during the pandemic when they were critical in scaling up the mRNA vaccine production for Pfizer and AstraZeneca.
In record time.
In record time. And they're applying that exact same highly specialized knowledge today to support the manufacturers of those GLP-1 drugs. They're taking these compounds from the lab bench to massive commercial production.
So it shows they can pivot that domain expertise to meet these high-demand, high-complexity market shifts.
Okay, so let's pivot to the financials, because the recent execution is really the bedrock for this aggressive future outlook.
And they delivered. Double-digit growth in key metrics for fiscal 25.
Specifically, Adjusted EPS achieved 15.9% growth year over year. It hit $6.12 for the full year.
And the margin expansion is key.
It is. The adjusted EBITDA margin expanded by 105 basis points, climbing to 13.9%. This validates the whole strategy. It proves they can extract more profit from every dollar of revenue by focusing on these specialized services.
And the clearest signal of future revenue visibility has to be their backlog.
A record. $23.1 billion. It's up a healthy 6% year over year.
And that backlog is highly defensible. Something like 29% of it, or almost $7 billion, is expected to be realized as revenue in just the next fiscal year.
And this strong execution is what enables the very aggressive forward outlook.
Right. The guidance for fiscal 26.
FY26. Adjusted EPS guidance is set at $6.90 to $7.30. At the midpoint, that implies a robust 16% growth.
Wait, 16% EPS growth is? That's really ambitious for any engineering firm, let alone one that has 32% of its revenue locked into fixed-price contracts.
It is ambitious.
Given the current inflationary environment for labor and materials, especially the specialized labor for AI facilities, how confident should we be that they can hit the margin expansion needed for that target?
That is the critical challenge embedded in that guidance. To hit that 16% EPS target, they are explicitly targeting another 50 to 80 basis points of margin expansion.
So how do they get there?
This is where their global delivery optimization really comes into play. Management is focused on operating leverage, the idea that they can deploy specialized global talent to service local projects efficiently. The only way they can fight inflation on those fixed-price deals is by having technology like Palantir and NVIDIA improve efficiency and by leveraging cheaper, high-quality engineering talent from around the world to support the big US and UK projects.
It's a tight balance.
A very tight balance. But they are clearly betting that digital efficiency will outpace those inflationary headwinds.
And coupled with this growth story is a very aggressive capital return policy.
Yes. In fiscal 25, they returned a record $1.1 billion to shareholders. That included $754 million in share repurchases.
And management has committed to being a regular buyer of its own stock. They plan to return at least 60% of free cash flow through buybacks and dividends.
That is an aggressive return schedule, especially when you think about that massive growth pipeline. If the data center pipeline is really fivefold, shouldn't they be hoarding cash for M&A to buy talent or patents instead of committing to big buybacks?
It's a valid question about priorities, but the answer goes back to their balance sheet. They keep a very clean balance sheet. The net leverage ratio is conservative. It's at 0.8 times.
Well below their stated target range.
Exactly. And that low leverage is strategic. One, it ensures the capital return is sustainable. Two, and this is more important, it provides optionality for a looming major financial event concerning their 65% stake in PA Consulting.
Right. The future of that investment is being negotiated now.
With a decision expected by March of 2026. Management is keeping that low leverage to ensure they have the financial firepower to, say, increase their stake in PA, maybe even take it to 100% if that turns out to be the best path.
So that decision represents a large near-term use of capital that adds a bit of financial uncertainty until it's resolved.
It does.
So we've established a really clear conflict here. We have a powerful bull case. It's supported by confirmed double-digit growth and this radical transformation.
But on the other side, you have these critical execution risks that are just baked into the business model.
Right. So the final decision for you, the listener, is the premium valuation justified by all this complexity and specialization, or is this just a high-risk bet on flawless execution?
Let's lay out the bull case. It rests squarely on the success of this transformation into a specialized digital integrator. Jacobs isn't just selling engineering hours anymore.
No, they're selling risk mitigation, complex system integration, advanced planning tools.
And we're seeing acceleration in exactly the right places. That 16% adjusted EPS growth target, the explosive fivefold increase in the AI data center pipeline, and the strategic partnerships with NVIDIA.
They've effectively positioned themselves at the nexus of several generational, high-spend infrastructure trends: water, transportation, AI, life sciences.
Which should ensure long-term demand for their specialized services.
Okay, but the bear case focuses on the risks you just can't avoid in this business. First and foremost is that exposure to fixed-price contracts. 32% of revenue.
And on a multi-billion-dollar project with a 3 to 5 year timeline, any unexpected spike in commodity prices or labor costs can turn a profitable contract into a material loss.
And that directly threatens that projected 16% EPS growth. Second, just the sheer scale and technical difficulty of their projects introduces operational volatility.
We saw that with the regulatory uncertainty in environmental services.
Right. Now scale that risk up to a giga facility in the desert. Any failure to meet schedules or cost targets in these highly complex end markets, whether it's because of technical problems with a new nuclear power source or permitting delays, it could materially impact their results. Flawless execution isn't just a goal, it's a financial necessity.
And finally, there's that impending liquidity event with PA Consulting. The need to maintain low leverage means capital is being held in reserve ahead of that March 2026 decision.
And while that's prudent, the outcome of that negotiation represents a huge near-term deployment of capital that will impact future strategy. The market doesn't like uncertainty, and that's a big cloud of M&A uncertainty still hanging out there.
Which leads us to our final provocative thought.
Given the immense pressure on the national grid, the need for it to expand 3 times by 2028, and the necessity for these AI factories to adopt highly complex behind-the-meter energy sources like modular nuclear or on-premise LNG, will the inherent risk and specialization required for these solutions ensure that Jacobs maintains its expanding premium profit margins far into the future? Or will the inevitable entry of other sophisticated firms eventually commoditize this highly specialized, newly acquired expertise?
We've defined the business model, quantified the aggressive growth drivers, and outlined the inherent structural risks. Risk defined, portfolio protected.